Today we're going to be going over the basics and the fundamentals of getting your construction project financed. Whether you have the best real estate and you have found the best location and you have the best team of architects and designers, the main part of your project is to get it funded. First thing you need to know about getting your commercial construction project financed is there are actually two different loan periods. The first period occurs during the construction and the second period occurs post-construction. So during the first loan period, you typically get what the bank refers to as a construction loan. During the construction loan, you are paying interest-only payments, and once the construction is completed, you still have to make a full principal balance payment plus interest. This is very important for you to get your project completed fast. That's why you have to ensure you have the best architect team and the best construction team, because the longer your construction project takes, the more interest you have to pay as a borrower. The second thing you need to know is what is stabilization, or when does it occur? A stabilization occurs when your construction project is completed and your building is ready to be occupied, or your building is ready to be occupied and you have occupancy in the building. The reason why stabilization is important because that has to be achieved in order for you to get a permanent loan. In a permanent loan, you get lower interest rate, you get a repayment structure, and you get a modified schedule of payments. So I'll be going over three different options you have as a borrower. The first option is what we already went over, which basically you get at the initial stage of your project, you get a construction loan. Once your construction is completed, your property has to stabilize and you have achieved some level of occupancy. Once that is done, you get what is called a permanent loan or a takeout loan, which basically you get a repayment structure and you get a lower interest rate. So option B is called a combination loan. In a combination loan, you are funded for the project during construction and post-construction together or combined. In a combination loan, your interest rate is pre-negotiated. Your stabilization conditions are defined up front, and your payment plan kicks in once the property is stabilized. Option C is called a balloon loan. In a balloon loan, you're making low monthly payments, possibly interest only, and then after a certain specified duration, you make a large final payment. In a tight financial market as of today, these are typically harder to obtain. So in the next video, we'll be going over how bank assesses risk and value, and also we'll be going over the collaterals that are typically required to get your project funded. Thank you for watching, everyone. Like and subscribe to our channel.